on here.
Okay,
so,
sure.
Yeah. So guys, welcome to another agent training. We are talking today about 1031 exchanges. So thanks for being here. We are joined by Sarah Coyview. Did I say it right?
Yes, very good.
Okay, perfect. So Sarah is here joining us, and she, is really going to run the show today. So Sarah, I'm going to go ahead and turn it over to you, and then I'm here if you need me.
Okay, great. Can everyone see my screen and hear me okay? And then Rosie, I don't know if, feel free to jump in, ask questions. I'll be looking at you, but I don't know if I can see everyone to see if you have your hand up or anything like that. So let me know if you want to jump in, feel free.
Sounds great. And Sarah, I'll be monitoring the chat as well. So I'll pop in with questions if anything comes in through there.
Okay, perfect. Yeah. We don't want to just hear me go on and on about exchanges, which I can do. So I've been facilitating exchanges with First American Exchange since 2002. So, and then Jeannie Burke, who's the business development manager in your region, has been with the company for 5 years. She will be happy once, I'm sure she'll have a little spiel when she jumps on later, but if you have clients that are looking for 1031 exchanges, to hop on calls and walk through the process. So this is what we do. We present, we let everybody know about all these crazy rules that the IRS has for 1031 exchanges. I'm just going to close my email so things aren't popping up. But so let us know. We're here to help you be the expert. We'll be the expert, but we'll help you look like the expert is kind of our goal. So let's see here. We'll just kind of jump right in to a little review of 1031 exchanges. Thank you, first of all, for everyone being on the call. I'm sure you're just as crazy busy as the rest of us are. Our business has more than doubled with increased depreciation of properties and the lower interest rates. So everyone is just going crazy. So what the clients are trying to do is defer tax on that big gain that they're having right now when they're selling. So they have to sell and buy real estate in order to do that. A little bit of history about 1031 exchanges. I don't want to take too much time on this and bore you with it, but it's kind of interesting. So 1031s have actually been around since 1921, but it was, I have real estate, you have real estate, we want to swap properties. So it was a deed for a deed. There was no cash involved. But in 1979, Starker, which you might hear these called a Starker exchange every now and again. It's because Starker was the first person that did a delayed or deferred exchange or a regular exchange. There's a lot of terminology. A corporation wanted to buy his farm ground, and he said, I don't want cash for it. I want you to go out and buy these 5 properties, and then we'll swap deeds, just like, the 1921 version. So they did that. It took, I think, like 5 years for them to complete this transaction. And the IRS said, no, like, this doesn't work. It has to be a deed for a deed. It can't be over time, whatever. They got into a court battle and he won. So that was the first deferred or delayed 1031 exchange. So the IRS is like, okay, you can do this. But then in 84, they put in all these rules. And then that was the birth of my job, the qualified intermediary, as a part of that. So the first step, we'll kind of walk through what has to happen for an exchange to occur. actually starts with you, right? You're helping clients negotiate contracts and things like that. So the first step in properly setting up a 1031 exchange is to make sure that there's 1031 language in the contract. The language doesn't have to be anything special, but we do have sample language that we could actually send out to everyone after. It just has to state that the buyer or seller intends to do a 1031 exchange, and usually with no obligation to the other party. The contract has to be assignable. So part of the documentation is an assignment agreement that we prepare, stepping in the shoes of the seller. So the qualified intermediary assigns the contract, and that gives the ability, I guess, for the closer to send the money to us. So we're acting as a seller. Let's see here. So the documentation, this is kind of a tricky one, has to be signed prior to or at the time of closing. So we'll get calls after the fact, like, hey, I intended to do this 1031 exchange, and they closed, they received the money, and at that point it's too late. So it's important, if you know your client's selling an investment property, ask the question, are you doing a 1031 exchange, to make sure that we're meeting all of these requirements prior to that actual closing of the sale. We talked about there's documents that we require a part of our file. So the exchange agreement that we prepare is the agreement between First American Exchange Company and the client, and how we handled the funds and the transaction. The assignment agreement we talked about, and then we have some other documentation that we need to open an interest-bearing account on behalf of the client. So while the funds are here, they earn interest. Let's see. The only thing that the changes on the closing side is besides the fact we have these additional documents that need to be executed, is the closing statement. So we'll show as intermediary on the closing statement, and then sign as the qualified intermediary, but we want the client to sign that they read and approved that statement as well. It's not required by the IRS that occurs, but it's a good paper trail for the client to make sure that that is done. We review the closing statement to make sure that there aren't any things that are being paid, like their Visa bill or their car payment or something. Nothing crazy like that ever happens, but to make sure that there's no taxable boot. But the common ones that are paid that can cause taxable boot, which means they would have to pay capital gains tax on that portion, would be rents and security deposits. So we see that a lot. We would suggest that they pay those out of pocket to avoid tax on that. Does anyone have any questions so far? I think we're good. Good, okay. Okay, so what does it look like when someone does a 1031 exchange? In order to fully defer capital gains tax, the client needs to buy the same or greater in value, debt, and equity. So if they're selling a property, in this example, for $1.8 million, they have to buy a property that's equal to 1.8 or greater to avoid the tax. So taxes, actually federal tax can be between 15 and 23.8 because of the additional Medicare tax. State, between 7 and 10%. And the big one for a lot of residential real estate investors can be this depreciation recapture. So if they've held title to a property for a long time, they are required to depreciate that property. And then when they sell that property, they have to pay back 25% of whatever they wrote off. So we'll get the call a lot of time where, okay, I'm selling my property for 250,000. It's fully depreciated. So they have to pay 25% of that cost. So sometimes that depreciation recapture is greater than their capital gains tax, and that motivates them to do a 1031 exchange. And then they also have to think about what they're planning on reinvesting into, because if you go from a building that you can depreciate to vacant land, so they can go from building to land, or building like a residential home to commercial property. But if they go to land you cannot depreciate. So they would have to pay that depreciation recapture. So it's something to think about. That one I have to bring up a lot. So this is what it looks like in this example. There's a sale without a 1031 exchange, and they would have $1,025,000 for reinvestment, but deferring those taxes, it keeps an additional $175,000 in the game, so to speak. So that's their savings, the cash that they're able to utilize to reinvest in more property. Any questions yet?
Yeah, Sarah, okay, forgive me if some of these are dumb questions. I'm just like,
Not at all.
this is so above my head that I'm just trying to keep up.
Mhm.
So what happens
Sorry.
if no, this is so good. We all need to try to dive into this subject more. But so for instance, what happens if the property that you're trying to purchase like doesn't equal in value to the one? Like, can you split that up into multiple different properties, or can you only exchange that first property to one other property? How does that work?
Right, you can reinvest into multiple properties. So we'll go over the rules to identify, but you can purchase multiple properties to equal that dollar amount. If that's not possible, so in this example, let's say you sell for 1.8 and you end up reinvesting 1.6. They would pay tax on the difference. So it doesn't fully negate the entire transaction or ruin the entire transaction. They just end up with what I call a partial exchange, where they're deferring some tax, but not all of it. One thing that we keep in mind, though, a lot of clients want to reinvest their profit, only the gain. But in doing that, chances are they're going to have a fully taxable transaction. For example, we'll have clients selling for 500,000, their basis is 200,000. So they want to only take that cash and reinvest that. So they would be buying for 300,000. Everything above their basis, now this gets a little deep, so let me know if you need clarification. They are deferring tax on everything that they reinvest above their basis. So they would only be deferring tax on 100,000 in that scenario and paying tax on 200,000. So chances are in that scenario, it might still make sense for them to do an exchange, but sometimes they're buying down so much that they end up with a fully taxable transaction. So I always tell them, make sure that you talk to your tax advisor to make sure you're deferring something by doing the exchange.
Okay, so if I heard some of that correctly, it's that if you can't get those two prices to match up perfectly, you're just going to pay taxes on whatever the difference between those two numbers is.
Right, exactly. But if they're buying down too much, just caution, make sure that you're deferring something. Sometimes their basis is really high, so they have to reinvest everything anyway to have a fully tax deferred transaction.
Yeah.
So that's something, there's a lot of factors that kind of come into play with that.
Okay, perfect. Natanya just asked a question. She said, have you heard of some of the new CG guidelines the current administration is thinking of instilling? Will that impact 1031?
Yes. So there's a proposal out there to limit tax deferral up to $500,000. So if your gain is 500,000 or less, you can do a 1031 exchange and have a fully tax deferred transaction. But if it's above that, you wouldn't defer tax. So it's not really clear yet. There's not clear guidelines on how it would work. If my gain is $1 million, I can't get any benefit from the exchange, that kind of thing. We don't really know yet. So, and then they are talking about raising capital gains tax to, oh gosh, I'm going to forget the number, 28.6%. So that's going to motivate people to want to do the 1031 exchange, but then if they have a huge gain, they won't be able to defer tax. So generally speaking, though, if it's just on a transaction by transaction basis, which we don't really know that yet either, it's not going to affect a lot of people because capital gains of 500,000 is a pretty large transaction, where the majority of our transactions are like residential real estate. So yeah, I think that pretty much covers it. And I don't know if Jeannie's available to talk though too, she might have a little more insight, so we can ask her later about the regulations.
Sounds perfect. Thanks, Sarah.
Yeah, no problem. So time frames. From the date of closing of the sale, the client has 180 days to complete their exchange. But here's the tough part in this environment. They only have the first 45 days to identify what they're going to purchase. And that's hard right now. So we have a lot of clients that are going out there, finding their replacement property, entering into the contract, trying to solidify that deal even before the relinquished property closes, which is, ideal. Because I've been having a lot of conversations lately where they're like, well, I have to close within 45 days because if I don't close, chances are my exchange is going to fail, which is true. So they have the 45 days to identify. Once day 45 passes, they have to buy something that they named. So if all three of those, so there are the rules. I think I have another slide on the rules, but we'll talk about them now. The first most commonly used rule is up to 3 properties. So they could name 3 properties to identify and buy any number of those. But if they all fall through, a couple of things happen. One, we can only release funds for purchase of what they identified after day 45 passes. And 2, they can't make any changes to that identification. So their exchange fails and we have to hold the money until day 181. So their exchange fails and plus their cash is tied up for, the 180 days. This slide too talks about tax returns. So if your client sells at the end of the year, I think October 18th is the magical date where your deadline, 180-day deadline, would push past the normal filing of April 15th. They would have to file an extension to get full benefit of that 180 days. And that's something that we as the intermediary would let the client know, like, this deadline's coming, so you have to file an extension. Any questions about that?
Sarah, this isn't necessarily a question about that slide, but just so that I'm understanding 1031 exchanges a little better.
Mm-hmm.
Are these, obviously this isn't the norm, like not most people are doing this. Really, what is the purpose of a 1031 exchange? I know it's to help you with capital gains. So is it only you're using this, like if you have an investment property or a flip that you've put a lot of money into? What's really the purpose?
Right. It's so I'm glad you brought up flip. 1031 exchange is used to defer capital gains tax on properties that you're holding for long-term investment. So it can't be properties that you're holding for personal use. It's income producing properties used in your business. So retail, gas stations, things like that. So there are holding period requirements when you do an exchange. So if I buy a house that I rent out for a month and then sell it, chances are that's a potential red flag because I haven't held it for a long period of time. If you're a flipper of real estate or a developer, you don't qualify to use 1031 exchanges. You can't defer tax. So developers and flippers are holding real estate as inventory, not long-term investment. So it doesn't work.
Got it.
Yeah.
Thanks for clarifying there. I appreciate it.
Yeah. Yeah. And it's so busy now. So it's all about the capital gains. So like I mentioned earlier, there's a lot of appreciation on properties. So people are just trying to move. I think with the proposed regulations or changes to 1031s, it's motivating people even more to, get rid of that property that they don't want and move into, go from this duplex to, a 8-unit building or something to that effect. So they're kind of taking advantage of everything happening right now to upgrade, I guess. Yeah. So just a little bit about our role. So our role is to make sure the transaction is properly documented. This is a part of it. Coaching clients on all of the rules is a part of it, but really our role is to control the funds. So the client cannot have any sort of receipt or constructive receipt of the proceeds. The intermediary has to be a third party. It can't be their accountant or their attorney, someone representing them. That could be considered constructive receipt. So it has to be a third party like us, a qualified intermediary. We kind of talked about the limits on receiving proceeds during the exchange. Who they choose as an intermediary is important. So First American is publicly traded, highly regulated. There are some, and I always like to tell like a story about a small intermediary that kind of took the funds. So there was an attorney in South Lake, Texas, years ago now. She decided to start her own qualified intermediary, 1031 company, and she took $1 million, and they found her in Chicago renting like a house for $4,000 a month and all of that. So I guess driving a fancy car, know who your intermediary is. We're, like I said, highly regulated. So your money is safe here, and First American actually guarantees the funds. So, and the accounts that we open are FDIC insured too. So a little bit more about our regulations. I guess we can kind of skim over that unless people have questions, let me know. So the rules, we talked about the 3 property rule already. They can identify more than 3 properties. So this is, every time I explain the identification rules, I'm like, how did they come up with this? But they can identify more than 3. So 4 or more, but the combined value of those properties that they identified cannot exceed 200% of their sales price. So keeping numbers simple, if they sold a property for $1 million, they could identify 4 or more properties, but that combined value can't exceed $2 million. So that rule's used not really with residential real estate where they're selling, for $200,000-300,000, because they might want to identify 3 $300,000 properties. So that's exceeding the 200% rule. But if you're looking at a multi-million-dollar transaction, that's where they could identify using the 200% rule. So if they exceed the 200% rule, this is where it gets really fun. They could move into the 95% rule, which would be, they could identify $10 million in replacement property, but they have to buy 95% of that value. So they would have to purchase 9,500,000, excuse me, in replacement property in order for that to work. So that being said, this rule is rarely used. I've actually seen it used in residential transactions from one client quite often, where they only wanted to use the 1031 funds as 20% down payments on multiple properties. So they sold for, 300,000, and they bought, 10 different properties or whatever it was. So they actually used the 95% rule, but the trick there is if like one or two of those properties fell through, their exchange would fail because they weren't meeting that 95% rule. But they've accomplished it just fine. Any questions about the rules? So that's where, your job gets a little more difficult and time sensitive, right? With helping clients try to find real estate within that time frame and making sure you match or fit within one of these rules. So any questions about that? No, you're good? Okay. All right, so we talked a little bit about boot, buying down, some closing costs like the rents and deposits, and then seller financing. I don't know if you deal with that at all. It kind of throws a wrench into things because that dollar amount, so if their buyer can come up with, 100,000 and they finance 200,000, it doesn't work. That 200,000 is taxable boot. So the easiest way that I've seen it handled is for the seller or the client doing the 1031 exchange to actually become the lender. So they have to have deep pockets, right? And they would loan their buyer 200,000. The buyer is coming in with 300,000 in cash to reinvest into the new property. So really they're kind of coming up with the cash for the acquisition at the time of the sale to do this workaround to avoid boot on those funds. So any questions about that at all? Gets a little confusing. We're good. All right. So we talked about the held for requirement. It has to be held for long-term investment, not personal use. I don't know if you have a lot of cabins or places on a lake, things like that in Indiana, but we do here in Minnesota. So we have a lot of people that talk about, well, I'm selling my lake property and I want to do a 1031 exchange. Is it held primarily for personal use or for investment? And they're like, well, it's my investment property, so it has to be income producing in that scenario. And they have to rent it. And then there's a limited time that they can use the property. So it's either 2 weeks out of the year or 10% of what they rent it is what they can use it for personal use. So it's very limited.
So Sarah, for instance, like if someone had a cabin that they were Airbnb-ing, they could only use that cabin for 2 weeks out of the year, and the rest of it needs to be full of income producing.
Right. Well, if they're renting it for 300 days out of the year, they could use it for 30. So it's whichever's greater.
Got it. Okay, cool. Sarah, we just had a question come in from Tatum. She asked, is there a cheat sheet for some of these requirements?
Yeah. Yeah, so I was thinking after this, I could send you the language we have, or I might have Jeannie send it over to you. And we have kind of just the basics that touches on these topics.
That would
So,
be
and
lovely.
we have a flyer for everything. So if there's ever something that you or your clients need a little more expertise on, well, one, always call us and ask us the questions, and then we could always send that backup information so you have it.
Sounds good. Thank you.
Yeah, you're welcome. Has anyone heard of a DST or a Delaware Statutory Trust? No, so like kind under the 1031 rules is any real estate for real estate used for investment. There are a couple of, I guess, products, I'll call them. It's an interest in real estate that qualifies as like kind. One, oil and gas. So you could sell your rental home and go into like a drill in an oil field. So you can buy a percentage interest in that qualifies. And I've had clients do it successfully. But another vehicle is a Delaware Statutory Trust. DST companies, they'll go out and buy a medical office building and sell clients a fractional interest in that DST. So it's a beneficial ownership interest and it qualifies as like kind. So that's kind of like a backup that someone will use. It's a passive investment. It's not they're not cleaning the toilets and or fixing the toilets, things like that. They just invest in this DST and then they get like monthly dividend checks. So they'll use that as a backup or to make up for that, gap in value that they're missing to avoid having to pay any capital gains tax. It's kind of nice to have just a little knowledge of what else can they reinvest in, because they might ask that question. Perpetual easements are exchangeable. I don't know if you come across that ever in your business, but that is like kind, but partnership interests is an interesting one. So if we're in a partnership and we want to sell, I want to do an exchange, but you want to cash out, I can't, because I personally do not have an interest in the real estate. So what we have to do is either have the partnership do the 1031 exchange because they're the taxpayer that owns the relinquished property, or we could change the structure of ownership prior to closing where you and I are 50-50 owners, and then we can go to the closing table. I can take my proceeds, put them in the 1031 exchange, and you can cash out and pay your tax. The problem with that is the holding period, because I've only held the property for a minute before I entered as an individual, before I entered into the 1031 exchange. So we get a lot of partnership interest issues because, they buy the property in this partnership and then, things change and they want to go their separate ways. So it's a potential red flag there. And then also moving into a new investment, we get that question a lot where, I want to buy into this project. I'll hear a lot, but usually it doesn't work because I need to receive a deed for an interest in the real estate in order for my 1031 exchange to work. Yeah, any questions on that?
Yeah, Sarah, someone or Lisa just asked, is there a time requirement for holding DSTs?
For DSTs or in general with real estate? It's a gray area with the IRS. So what the holding period is, the they state that you have to hold the real estate to prove your intent of investment. So there are varying opinions on how long that is. We think a good conservative holding period is a minimum of 2 years to prove your intent of investment. Some tax advisors will say over a tax period, or some will say 5 years. Obviously, the longer you hold it, the less question there would be about your intent of holding it for long-term investment. So I don't know, did that answer the question? I know a DST, I'll just kind of talk about that a little bit. If you invest in a DST, you're kind of locked in, not kind of, you are locked into that investment until the DST company decides to sell that asset. And it's usually between 5 and 7 years.
I think that's good, Sarah. Thank you.
Good?
Yeah.
Okay. All right. No other questions there. Oh. So holding period, we just talked about that. Let's see, same taxpayer, we kind of talked about that. One exception to the, how we hold title is if I'm the sole member of an LLC, I have a little bit of flexibility on how I reinvest into the new property. So if I'm that entity, if I'm the sole member, that entity is disregarded for tax purposes. So I'm the taxpayer. So it's looking at me as an individual. I'm filing my individual tax return. So every time I reinvest into something new, I could create a new disregarded entity. But as soon as, I had another individual join that LLC, it would become a partnership. That would ruin the exchange. It changes who the taxpayer is. So the IRS is looking for continuity of investment there. My social security number sold, my social security number is buying. We talked about the drop and swap. One question, especially lately, we've been getting a lot of related party issue questions. So you cannot buy your replacement property from what the IRS defines as a lineal descendant. So it can't be mother, father, sister, brother, aunt, uncle, grandma, grandpa. So it has to be from a separate third party. If I do buy, let's say me and my sibling are both real estate investors and I want to buy their property, as long as they're doing a 1031 exchange and we reinvest for a minimum of 2 years, we could do an exchange because neither one of us are cashing out. And what the IRS are looking to avoid by doing that is basis shifting. So selling low basis property for high basis property and so on. I'm not an accountant, so some of you might understand that a little bit more than I do. Seller financing, tax years, I think we pretty much covered other issues, just kind of being sensitive to time here. So I'm gonna kind of cruise into reverse exchanges. Is anyone familiar with a reverse exchange? So they're very, very popular right now because of the climate, I guess. As soon as a property goes on the market, it's gone. So a lot of people are having a hard time identifying new property. So what happens is they're going out, they're getting a contract, they have to buy it. So, and they call me, I have to buy my replacement property and my relinquished property hasn't sold yet. Well, there's a way we can structure a reverse exchange where you buy before you sell. What happens is they can't take title. So we form a LLC, it's called the EAT, the Exchange Accommodation Title Holder. And the EAT takes and holds title until the relinquished property sells. It gets a little complicated. So again, they have to either have the cash to buy the property before the relinquished property sells, or a third party lender. The lender has to be comfortable with the structure because this LLC that we form has no assets, but the client or the buyer is guaranteeing the note. So really they're in the same position that they normally would be. And then once from that date we take title, they have 180 days to sell the relinquished property and take title to the property that we are holding on their behalf. So any questions about reverse? It's a good tool, but it's more costly to do than a standard reverse exchange because there's increased liability on our end. We're getting in the chain of title. If it's a property that's anything other than residential, 4 units or less, we require a clean phase 1 environmental report. So that's also an additional cost to doing that type of transaction. So while we're in title, we're only the title holder. We don't want any responsibility for the property. Our entity can't have any income, so we enter into a lease that gives the client full control of the property and the ability to collect rents or whatever it might be associated with the property. And then the funds that they come in with to buy, we in turn give them a promissory note. So once the relinquished property sells, we have a third transaction where then the client, they sell their relinquished property. It's a deferred exchange at that point. The funds come in to their exchange, and then the third transaction is where they buy, in a sense, from our entity. So we would either convey the membership interest of the LLC, we pay off that promissory note for any cash that they brought in advance of closing. So the challenges, like I said, they have to have either cash or be able to get that loan. They have the same time frames as a regular exchange, and it does cost more. Roughly, I would say our fees generally are between $6,000 and $8,000 for a reverse exchange, where a standard exchange, I'll say, is roughly $1,000 to do. There is a way to structure an exchange where they can include improvements. So if they are selling a building and they want to buy vacant land, this is the most common one, and build storage units on it, they can do that in the exchange. We take title just as we would in a reverse exchange during the improvements. So if they're buying the land for $100,000 and they need to make $200,000 in improvements, they can do that. They're limited to the 180 days to make improvements. But by or on day 180, we would convey the property to them at the increased values. So if they sold for $300,000, they bought land for $100,000 and made $200,000 in improvements, they could fully defer tax by doing that type of transaction. Any questions on that? No? Anyone's head spinning yet?
Mine is like for sure. But
yeah.
I mean, rest assured, you sound so smart. I'm like,
oh,
wow.
I'm just worried that I'm kind of all over the board and confusing you. So let me know if you have questions.
You're doing great.
But really, that's kind of the end of the types of exchange, the rules involved. Are there any questions, any experiences that you have questions about that you want to go over?
Agents, this time is for you. Feel free to speak up or drop it in the chat if you want to ask anything.
Right. So I have right now, there's some state regulations. So states like Pennsylvania, they don't recognize 1031 exchanges. So if you do an exchange in that state, you're paying state tax. So Arkansas and Vermont are the same. If you, the clawback provisions there, like California, if you own an investment property in California and you reinvest outside of the state, you have to pay state tax. And then there are some states that have regulations on qualified intermediaries. We are not regulated. So again, know your QI, but these states listed here, they have requirements like insurance requirements and so on for qualified intermediaries, and First American meets all of those. I don't know how many states you deal with, but
That's
just
great.
a thought there.
Yeah, we've had a couple of questions come in. So Tatum just asked, can you use a 1031 exchange for vacant dirt to an investment property? Is that considered like kind?
It is. Mm-hmm.
Perfect. And then Jamie asked, how far in advance of the transaction do we need to bring in a QI? Also, what is a QI? You might have said that.
I'm sorry.
No.
The basics, like I should have said that at first, qualified intermediary. So that's what we're the QI, the qualified intermediary.
Sarah, I'm sure you did say that, but my brain is just trying to keep up. So yeah, how far in advance of the transaction do we need to bring in a QI?
Well, lately at the closing table seems to be very popular, but a couple days in advance is nice, and it's simple. So we just need to know who's closing it. We get a copy of the purchase agreement and title commitment, and we can whip up our documents. But yeah, a day or two in advance of closing gives us enough time.
That's great. Anyone else want to unmute or drop a question in the chat?
I think Jeannie is coming on, so that's good.
Oh, perfect.
There. I suppose I can stop sharing.
Okay.
Hi, Jeannie.
There we are. Good morning.
Morning, Jeannie. Thanks for being here.
Well, thanks for having me. Sorry, I had a little issue this morning, but all better now.
Okay. We are, yeah, just kind of wrapping up, but is there anything else that you would want to add? Any helpful advice or tips?
I don't think so. Sarah covered it pretty well. I suppose, from my point of view, the biggest advantage for all of you is just being able to recognize when a client is in a position where they could benefit from a 1031. There's a ton of people out there who still have no idea what 1031s are, how they work, or the benefits to them. So as you're going along with a client in a transaction, even if you can't remember a lot of the details from today, because I know it's a lot of information to take in, but generally speaking, if you know that, okay, they're selling a piece of property, are you interested in buying another piece of property? If you know it was investment property, have you ever thought of a 1031 exchange, and have you looked into that to see if it could benefit you and save you some tax dollars? So I think that's one of the greatest benefits, is just kind of knowing just the basics of what it is. And then you can always refer your client back to us to talk about the specifics and talk them through it to see if it would work for them. But just kind of having that ability to recognize that just kind of, makes you that much more of a hero to your client to, to suggest that, and, you just saved me $200,000 in tax, that's great. So anyway, I think that's a huge benefit, just to kind of just be familiar with these points, but then always you can refer them back to us or contact us and we can answer your more specific questions.
That's so helpful.
Right. Jeannie, did you hear me fumble over the proposals to the changes in 1031? Do you have anything in addition to that, or is it just the 500,000?
Yeah, that's the only thing I've heard so far. Yes, I think, there's talk about raising the capital gains tax rate, like you mentioned. But so far, it seems like this $500,000 cap on the gain is the main well, maybe it's the main thing, maybe there are other ancillary things, but that's definitely the thing that everyone is focusing on now. And you're right, there's not a lot of clarification about exactly how it would work, but it's something that our company lobbies, very hard for, retaining 1031s as they are. And, we're constantly getting the intel and in the know. So, as things go along, if you ever have questions, just come to us and ask, and we might, have some updates. So.
That's so good. This is maybe another dumb question, but I know you guys are based in Minnesota and we're in Indy. Are you guys still the people we should reach out to when we have 1031 exchanges going on?
Yeah, so physically I'm in the Chicago area, but Indiana is part of my territory. So before COVID, I was in Indiana, once, twice a month, so hopefully we're going to be getting back there soon. But yes, I would be your go-to person. And then Sarah and I work together on the deals that come in.
Perfect. That's great. Thanks, guys. I'm going to say one last time, anyone have any other questions that they want to lob out?
Right, and then I don't know if you could get, or if you want Jeannie to send you some information and her contact information if you want to distribute it, or if there's a list that we can get, whatever works for you guys.
Yes. Anything that you guys could send us would be amazing, especially that cheat sheet that we were chatting about, and the slides that you went through for this presentation would be amazing.
Oh, sure. Yeah.
Great. Okay, guys, then we're gonna call it for today. Thanks for coming. Tomorrow, remember, we are back in person in our 16th Street office for the second session of the DISC personality profile. So hope you can make it. Have a good one. Thanks, guys. Thanks, Sarah.
All right. Thank you.
All right. Bye.
Have a great day.